Okay, chapter 2 of this auditing journey. So the type of auditors. How many type of auditors we have? We have here they're saying 4 type of auditors. We have the internal auditor inside of the company, external auditor outside of the company, government auditors, which are dealing with government organization, and forensic auditors. Those are the ones who are hired probably for some courts and some for the legal issue that's doing some investigation on the forensic matters. Type of the audit, we're going to have the audit service, which audit service include the internal control audit, compliance audit, operational audit, and forensic audit. We're going to have the assurance services, which auditing is specialized from the assurance service only, and the non-audit services, which is the tax preparation, planning services, management advisory service, compilation and review services. So most of the company, the small company and the small private companies, they not require audit. Why? Because they're not publicly traded, obviously. So what they need is only compilation and review engagement. Now, those public accounting companies, we have the big fours, then we have a middle one, we have some which are related to our region, which will be BC, and we're gonna have some local, which will be related to the particular city or some practitioner which practicing somewhere in the small areas. The big four, we already know them, which are the Deloitte, Ernst & Young, PwC, and KPMG. There was Arthur Andersen, but we're going to see later what's happened with the other Andersen. So they disappear from the big five, so they'll become a big four. Then we have those mid companies, which is Grant Thornton, BDO, RCM, and there's one Manning Elliott, but I think Manning Elliott is more like a regional rather than a mid-tier company. And then we have some local small businesses. The team members of the audit team is we're going to always have the partner, which is in charge. Partner will be the part of the company level. Then we're going to have a manager who's going to manage the certain type of the audits. Then we're going to have senior in charge and staff or associates, which will be the one who actually do the audit. If you think that for the existence of the, let's say we have to audit a mining company which have a mining facility somewhere in Africa. If you think that the senior or the manager is going to go in Africa to check what's the inventory and the existence of the inventory, that's not going to happen. The law, that's why we have all those students who's coming from the different universities in our company, so they can do that small jobs. So, which are the duties? You can see here the partner, what the partner is doing. His research agreements, ensure the staff, the audit is properly planned, assessment of the audit team, supervise the audit team. Manager is the one who ensure that the audit is properly planned, including scheduling and team members. Supervise the preparation and approve the audit program, review the working papers, dealing with the invoicing, ensure the collection of the payments for the services, and inform the department about the auditing of the accounting problems if there are any problems that happen during the audit. Then we have the senior in charge, which assists the development of the audit plan, prepare the budget, assign the task, perform the procedures, supervise and review the work of the associates, and inform the manager if something goes wrong. And the senior, the associate or the staff is the one who actually doing the audit procedures. prepare the adequate and appropriate documentation, and inform the senior staff if something goes wrong. So you can see how the duties of the importance of the duties going down with every single level. And at the end of the one of the last duty of any of those members is that they to inform the higher level if something is there's a problem that they have encountered during the audit. What's the time change for the audit? Well, it was very interesting because the audit as an audit work that has been performed was very extensive, and at some point the auditors find it that they're not making enough money from audit. So what they start doing is they start doing actually providing consulting services of how to reduce the audit risk in the company. So to some extent, we may say that the auditors become a consultants for the company, how to eliminate the audit risk, how to improve the internal control, and after that, the auditor goes to the same company and doing the audit. Well, that was okay up to a certain point, and the auditor was making more money from those management contracts rather than the audit. The audit usually costs between 50 and 60, $80,000, depends on the size of the company and where the company is listed or which stock exchange. So only making 50, $80,000 on audit, that's not much you can make. So that's why they're getting with those management contracts or consulting contracts, which they're making the big chunk of money. And that continued till 2020. 2020, what's happened is there's interesting happen. WorldCom happened, Enron happened, Nortel happened. Arthur Andersen is the one who was involved in Enron. That's why Arthur Andersen is listed here. Arthur Andersen, I was under audit of Arthur Andersen members when I was doing audit. So those scandals, if you want to go back, they're always related to, if we have to take a first chapter and see to what they related, the scandals. First, the WorldCom was related to the classification. It wasn't about the accuracy, it's about the classification on the accounting balances. So what happened there is the owner of the company or the management of the company decides to, instead of capitalize, instead of the expense, the amount that they're doing for the research and development, they decide to capitalize it. And they were doing this for like a number of years. And obviously the assets going up, the expenses are low, the company showing high income, earnings per share high, the expectation of the market growth start growing, the market price going up, every life is beautiful until one day the auditor, not the auditor, but the company decides, okay, that's enough, and auditor cannot cover that mistake for a long period of time, and they decided to fix the mistake. So what they said is, okay, we made a mistake, honest mistake. Instead of expensing some things, we capitalize them. So now we're going to get the corrective action. We're going to expense them. So they did expense them. The problem was that the amount was, I believe, $2 billion or $5 billion, something like that. And that obviously affect the stock price. And within one day, the stock price went down to zero. The next one was Enron. Enron, there's interesting movies that we can watch. There's some serious movie, there's some funny movies about Enron. If you want to watch Fun with Dick and Jane, that's on the time of the Enron made that movie. Arthur Andersen was the one who was involved, who was auditing Enron, and they're the one who actually tell Enron what to do in order to do what they did. And they were working with the special entities. Special entities, the one that we saw in financial reporting, which are created for certain purposes, mostly to hold the borrowing. So all the special purpose entity was holding the borrowings, and all the assets were in the Enron. So Enron books look clean, where all the liabilities was pushed on the special purpose entities. And at some point, they have to disclose that one, and they did disclose it, and Enron technically disappeared. And that was a huge scandal in US. After that scandal, obviously the regulators usually step up when there's a big scandal. You have to understand this. Regulators not doing anything until something happened in reality. If something happened in reality, the regulators then they step up and start changing the regulations. So in United States, they introduced this Solvency-Oxy public. So that means the public accounting reform and Investor Protection Act. They start the regulation of the audit profession. They changed all the way that the audit has been done up to this point. In Canada, there was a bill 198. We're not going to spend too much time on those one. So the society, what's the society expectation? Obviously, the society expectation means that when the auditor cites the report, that means the auditor report is actually accurate, and the financial statements are free of mistakes and errors, which doesn't happen because Arthur Andersen actually signed those reports and turned out that they are fraudulent. So because of the nature of those audit evidence, as you can see, the audit evidence and the characteristic of the fraud, auditors are able to obtain reasonable but not absolute assurance. This is kind of wrong statement here. Try to, how can I say, to minimize the impact that the auditors had on all those scandals. I would say the auditors are the one that creating the whole situation, and they did the whole the not right things which harm the society in the way that no one else can be harmed, can cause that harm. And that's why all those regulation was changed to prevent the auditors to stop doing what they were doing. So responsibility of the financial statements. Who has responsibility? All the responsibility are on the management. Auditor have the important responsibility. However, the manager is the primary responsible to make an effective internal control and ensuring the fairness of financial statements. That's why we're going to see, I'm going to show you some audit reports, and you're going to see there's a statement that says that the auditor is not responsible for anything. And if there's a mistakes, that's management responsibility, not the auditors. If the auditors didn't catch those mistakes, that's how they wash their hands, and they're saying, okay, management is responsible, we're not responsible for those. On the context of the financial statement audit, the business or the entity being audited is the primary context that shapes the external auditor environment, and how you apply the audit tools on many particular engagements will depend on generally on the nature of the entity business. So basically, we as an auditor we're only going to do audit obviously in the publicly accountable enterprises, but how we're going to do and which tools in the audit tools we're going to use, that will be depend on the nature of the business, environment, of the current situation. That's why we have this partner, who this partner decides on the audit procedures, audit approach, and anything that has to be done during the audit. So I'm saying audit approach and audit procedures. You have to understand those are not the same things. Those are different things that we're gonna see going forward to the audit. Now the model of business is obviously every business is in different industries. So the auditor itself has to get some knowledge about that particular industry, and in order to perform and plan the audit to the level that to provide a reasonable assurance to the user of the financial statements. So what we're going to have here is that will be the overview of the organizational operations. We're going to have the governance, business objective and strategy, business process, risk control, and reporting. This is kind of governance of the company, related to the governance, which governance was touched by my colleagues in the managerial accounting, I believe. So the management and the board of directors is the one that's gonna organize of the objective and the strategy for the companies based on the company's objectives, goals, and based on the strategy which was chosen by the management and business board of directors. Then they're gonna start the process of we can have here the purchasing process, revenue process, finance process, human resource management process, and inventory management process. All those, as you can see, is for one purpose and one purpose only, to meet the organizational objectives following the strategy that was chosen by the company. Somewhere in the middle, we're going to have this risk assessment, and we're going to work proactively to find the risk, mitigate the risk, and eliminate the risk. That's why every organization, even Accent School of Management, as you know, has a risk manager. Then we're going to have the control, which control is going to make sure that first the objectives are met. Second, the company actually follow the budget and follow the objectives and follow the strategy which was chosen by the management and board of directors. And at the end, we're going to prepare the reports, and we're going to make some performance of management and assessment and external financial reporting for the outside users. So as you can see, to some extent, we're covering a little bit managerial accounting here in terms of the governance, objective strategy, business processes, risk and control. Reporting is the financial reporting only. Auditor has to have understanding about the company, the business, the environment, and everything in order he to plan the audit properly and he to be able to catch everything. So let's see this. Why might understanding of the entity business model be important of the financial statement auditor? What do you think about that? Why is it important for the financial statement auditor to understand the characteristics of the entity business model?
Because it's easier to audit the information, to know. We need to know what is the operation for the company, to know exactly what type of documents we need to check. And I think,
Okay.
yeah.
Yep. Also, we need to understand the business. We need to understand the business model, and we need to understand. That's why sometimes it's difficult, I guess, from the auditors because the auditors are definitely they don't have understanding about managerial accounting. I have to be honest with you, and usually then the people who dealing with audit have a big problem with the managerial accounting, which is fine, but the auditors still have to understand about the business model, understand how the company works, which are potential threats, what's the business management concepts in the company in order to plan appropriately the audit and in order to find the level of assurance which is required for those financial statements that they are about to review. Now the corporate governance is we're going to have inside the company, that's in the business organization, exists to create the value to the stakeholders, obviously. We already know that from the managerial accounting, and the way that we using the resources or we're going to tell us how well we are managing the resources which are provided by the owners of the company. The system that has to be in place to make sure that the resources provided by the owners are used for the appropriate reasons is going to be that corporate level of corporate governance which is necessary and which require management to be overseen and supervised. So who's going to provide that corporate governance? That will be the board of directors first, which are going to oversee the entire company, and inside we're going to have this audit committee. But again, you have to understand, we're not talking about here about a small public company with a small not public non-public company or private company. We're talking about the big public corporations here, which have actual board of directors, which actually have actual audit committee. The body which is primarily responsible for the management oversight is the board of directors. Now the audit committee, which is consists of the subset of the independent board members, oversee the internal and external audit works done by the organization. So basically the audit committee is the one who the auditor is going to rely when he assessing the audit risk. We're going to see the risk type of risk that we have in the organization and how the auditor manage those risks in order to reduce the audit risk. But the audit committee will be the one who's responsible for the internal audit work and external audit work in terms of communicating with the external auditor and provide with the external auditor with the necessary information for the audit. Then we're going to have this model of the business process with the 5 components again, and we're going to focus on the process which are create those business transactions. Now the auditors typically organize the financial statements audit into the 5 business processes. It's important for you to realize this because later on we're going to focus on this. Later on you're going to see in the CPA, when you go to CPA, they're always choosing the questions from this type of business, typical the financial statements, the business processes. They're always chasing those business processes. The most important is revenue process. Revenue process, which including the revenue recognition, the existence, the accuracy, the completeness, the cutoff, everything. Financing process. So the revenue is where the resources come from the operation. Financing process is where the capital comes in the company. So we're catching all the inflow of the cash here. And after that, we try to chasing where the cash goes. Obviously, one of the outflow will be the processing process, which is related to basically the company is manufacturing or merchandising. That will be related to the normal process of the operation of the company. Then we're going to have the human resource management, which is related to our labor. On the management accounting, if you want to put it in the management accounting thing, think about direct material. Purchasing process will be direct material and indirect material. The human resource will be direct labor. And the last one will be the inventory management process, which inventory management process is related to the finished goods or the merchandising inventory. So once we catch all those five, we basically have everything in the company. Because we're getting the money that's coming from the normal operation of the company, we're getting the capital that's coming from the financing. If you remember the financing section of the cash flow, we're chasing the long-term debt and contributed capital or equity section. Then we're going to chase the purchasing, which is all the purchasing related to the normal operation of the company plus the production and anything else. Then we're going to chase the human resource, which is the direct labor, and inventory management is the one that is that from where we have to sell in order to create the revenue. So if we have to go, we auditor, let's go with this knowledge assessment here. How might the component of our model differ from an entity in automobile manufacturing versus banking? And how might those differences affect the audit work? That's what we're chasing here. Because every company, if we're chasing this model with the business transactions, with the five processes, basic processes, how there's going to be different between the automobile manufacturing company versus bank? What do you think? Both's going to have the revenue process, correct? The
Yes.
bank's going to have the revenue process. The automobile manufacturing company also going to have financing process. Both's going to have it, but now the financing in the bank is different, right? Purchasing process obviously for the automobile company will be huge. Where in the bank, what we're going to chase on the purchasing? How they invest the money, which are given to them by the normal people. Human resource management, that might be similar, and the inventory management process, that will be interesting because in the bank we don't have much the inventory, correct?
Yes.
Where in the manufacturing, with the automobile manufacturing company, that will be the huge element. So let's see organizations that affect the audit in Canada. That first one will be the Canadian Security Administrator. CPA obviously is going to affect the auditors. Then we're going to have Canadian Public Accountability Board. Then we're going to have the Audit and Assurance Standard Board. And then we have all these standard boards. You can see how many institutions affecting the audit. On the international level, we have the International Accounting Standard Board and we have the International Audit and Assurance Standard Board. On the international level, they are a little bit more structured and not that spread, where in Canada, there's a duplication of error, obviously, a lot of decentralized system. So technically Canada, what the Canada needs is Elon Musk to come to Canada to find out the duplication of effort and get some people out of the system, I guess. But let's go with the auditing standards and see auditing standards help to ensure that the financial statements auditors are conducted in the consistent and true manners and they serve as an important set of criteria for the evaluating the quality of the auditor performance. So basically the accounting auditing standards are in a way to protect the public and make sure that the auditor actually are consistent. They using the same approach regardless who is the auditor, and the quality of their work is the same. That's the purpose of the standard. Same thing with the CPA standards. CPA standards make sure that all the accountants across Canada have meet the minimum requirements to perform the accounting services and have the basic knowledge on everything which is needed they to be a CPA. So audit standard setters, who are the audit standard setters? In Canada we have so many. We have Audit and Assurance Standard Board, then we have Canadian Public Accountability Board, and then we have the International Audit and Assurance Standards. This is non-public company, this is public company, or this is for the non-public companies audit. Audit Assurance Standard Board. Canadian Public Accounting Board is for the public company, and the International Audit Standard Board is a work of the 125 international jurisdictions. That means it's accepted by 125 countries around the globe, including Canada in this case. The principle of the underlying audit is the principles underlying audits. Audit is conducted in accordance for generally accepted auditing standards. Is a pre-phrase of the Accounting Auditor and Assurance Standard Board auditing standards. Those principles are grouped into the 4 categories. First one is the purpose and the premises of the audits. Second is the responsibility of the auditor, performance of the auditor, and the reporting. And those extracts from the different parts of that document issued by the Audit and Assurance Standard Board. We're going to have the purpose of the audit here, and you can see what the purpose of the audit. Purpose of the audit is to enhance the degree of confidence of the intended users in the financial statements. This is achieved by expression of the opinion by the auditor on whether the financial statements are prepared in all material respect in accordance with the applicable financial reporting framework. In the case of most general purpose frameworks, this opinion is whether the financial statements are presented fairly in all material respects or give a true and fair view in accordance with the framework. And keep going with this. Responsibility of the auditors. This auditor is responsible for having appropriate competence and capabilities to perform the audit, complying with the relevant ethical requirements, always ethics is involved, maintaining the professional skepticism and exercises professional judgment through the planning and performance of the audit. So not generally to have those one, but through the process of planning and performance of the audit. And then we're going to have the principle, the performance. What's the performance? To obtain a reasonable assurance, which is a high but not absolute level of assurance. The auditor has to plan the work properly, determine and apply appropriate materiality level, identify, assess the risk material misstatement. So that's where we're going to focus next thing. We're going to focus on the plan, how we're going to plan the work, how we determine the materiality, how we're going to identify and assess the risk on the material misstatement, how to obtain the sufficient appropriate audit evidence, and which technique we're going to use. That's the purpose of auditing. But before we start doing that, you need to get a little bit understanding about the audit process, audit report, and all the conceptual framework which govern the audit. Reporting. Based on the evaluation of the audit evidence obtained, audits are expressed in the form of the written report, which we saw have a different elements of the report, an opinion, which will be unqualified, qualified, and the other two in the opinion or denial of opinion in accordance with the audit findings. The opinion states whether the financial statements are presented fairly in all material respect in accordance with the applicable financial reporting framework. And the nature of the audit standards is that Canadian audit standards, and we have the international the international audit standards, which are similarly and have a conceptual framework of the accounting standards. Now, for the audit standards, we're going to have now Canadian audit standards. CAS is the what's the standards which are numbered, applied in order to which standards are issued by the International Audit Assurance Standard Board. So first one will deal with the general principle of responsibility. Next one will be risk planning and the risk assessment. Next one is how to gather the audit evidence, how using the work of the others, audit conclusion and reporting, and some special consideration. Those are the sections under the Canadian auditing standards. Now, international standards of audit, which are part of the International Audit Assurance Standard Board, consist 36 individual standards covering the full range of the audit topics. Again, we have to talk about ethic and professionalism. On the ethic, auditors are bound by the CPA Code of Ethics, which is a system or code which is of conduct based on the moral duties and obligation, which indicate how the auditor should behave and how the auditor should not behave. Professionalism is obviously the conduct aims in the qualities that characterize the professional or the profession. Now, the rule of professional conduct says that all professionals, now who are the professionals here? As you can see, medicine, law, and accounting operate under some type of code of ethics or code of conduct. Which is our code of ethics? That will be CPA rules of professional conduct. And the CPA rules applies to all the auditors, including those auditing public companies as well. So basically, if you have to conclude on this one, obviously auditing is the large and vital profession. And there are many important components about audit which we have to learn this semester.